So, what if I told you that the real secret to being a successful investor has almost nothing to do with genius-level math or taking wild, risky bets? Today, we're diving into one of the most important books ever written about money, Benjamin Graham's The Intelligent Investor. Now, this isn't some get-rich-quick guide. It's a whole philosophy, a timeless framework that has literally shaped the world of investing for decades.
And hey, you don't have to take my word for it. When a guy like Warren Buffett, arguably the most successful investor of all time, calls it the best book on the subject ever written, you kind of have to listen. He first read it way back in 1950, and he says it's still just as true today.
That's the million-dollar question, right? And it's exactly what Graham sets out to answer. But his answer might really surprise you. It has way less to do with your IQ score or fancy algorithms, and everything to do with your character, your discipline, and your temperament.
To really get Graham's solution, we first have to understand the problem. And he argues that the biggest risk you face isn't a stock market crash. Nope, it's the person staring back at you in the mirror.
Just let that sink in for a second. We're talking about Sir Isaac Newton. You know, the guy who figured out gravity, a certified, world-changing genius. And even he got completely wrecked by a stock market bubble.
Yeah, Newton got sucked into this thing called the South Sea Bubble. And the crazy part is he actually made 100% profit and cashed out. But then he saw his friends and neighbors getting even richer, got a serious case of FOMO, and jumped back in at the very top. He lost a fortune, over $3 million in today's money. He famously said he could calculate the motions of the heavenly bodies, but not the madness of the people.
And that right there is Graham's central point. Newton's failure wasn't an intellectual failure, it was an emotional one. He let the irrationality of the crowd hijack his own incredible judgment. And that is precisely the danger Graham wants to arm us against.
So, who is this guy who claims he can help us conquer our own worst instincts? Let's get to know the man himself, Benjamin Graham.
Look, Graham wasn't just some academic living in an ivory tower. This guy lived it. He got nearly wiped out in the Great Depression, losing almost 70% of his money before battling his way back. He basically invented the entire idea of value investing, taught at Columbia University, where he mentored a young Warren Buffett, and he literally wrote the book that turned investing from a game of hunches into a real profession. His wisdom was forged in fire.
Okay, this brings us to what is probably the single most important idea in the entire book. It is the absolute foundation of everything. You have to ask yourself, are you an investor or are you a speculator? Because they are not the same thing. Graham gives us a super clear, almost scientific definition. To be an investment, an operation needs three things. 1. Thorough analysis. 2. Safety of your initial capital. And 3. An adequate return. Not a mind-blowing return, just an adequate one. If you're missing even one of those pieces, you're not investing, you're speculating.
Let's just break down the difference in how these two people think. The investor is digging into the business itself, its real value, its future. They're buying a small piece of an actual company. The speculator? They're just betting on which way a little blip on a screen is going to move. They follow the mood swings of the market, hoping to make a quick buck.
And his warning here is pretty stark. He says, look, speculating can be exciting, but if you think it's a serious way to build wealth, you're fooling yourself. It's just like trying to beat the casino long term, the odds are stacked against you, because you're playing a game of luck, not a game of skill.
And you can see exactly what this looks like in the real world. Just think back to the dot-com bubble. People weren't investing in businesses, they were just trading ticker symbols like crazy. I mean, when the average person holds a stock for only 6 days, you know that thorough analysis has completely left the building. That's pure gambling. And we all know how that story ended. So, if we're not supposed to be speculators, how do we actually become intelligent investors? Well, Graham gives us a really powerful and surprisingly simple framework. It's built on 3 golden rules.
This is rule number 1, and it is a massive mental shift. You are not buying a lottery ticket. You are becoming a part owner of a real, breathing, operating business.
You know, when you start thinking this way, everything changes. You stop asking, where will the stock price go tomorrow? And you start asking questions an owner would ask. Is this company actually making money? Is it run by smart people? Does it have an edge that'll last? Suddenly, the daily zigs and zags of the stock price become way less important than the long-term health of the company.
All right, rule number 2 is all about how you deal with the fact that the stock market is, well, kind of bipolar. The key is, you don't take your marching orders from its crazy mood swings. Instead, you use them to your advantage.
Graham describes the market as this giant pendulum, always swinging back and forth between wild optimism and total despair. So the trick is, you don't let the pendulum swing you. When it swings way over to pessimism and everyone is panicking, that's when great companies go on sale. And when it swings to crazy optimism and everyone's euphoric, that's your chance to sell to them at a fantastic price. You use the market's emotion, you don't get swept away by it.
And here it is. This is probably Graham's most famous idea. It is your ultimate defense against the one thing you can never, ever escape when you're investing, the fact that you're human and you're going to make mistakes.
So what is a margin of safety? Just think of it like building a bridge. If you calculate that a bridge needs to hold 10 tons of weight, you don't build it to hold exactly 10 tons, right? No way. You build it to hold 20. That extra capacity is your margin of safety. In investing, it's the gap between what a business is actually worth and the price you pay for it. If you think a company is truly worth $100 a share, you wait patiently until the market offers it to you for, say, $60. That $40 difference, that's your cushion. That's what protects you if your analysis was a little bit off.
So, when you pull all of this together, what does it all add up to? It's not a secret formula for outsmarting the market. Graham is super clear about that. It's a formula for controlling yourself and ultimately for achieving a kind of financial sanity.
When you boil it all down, it's really these three powerful ideas. First, by always insisting on a margin of safety, you minimize your risk of losing your money for good. Second, by thinking like a business owner, you maximize your chances of getting steady, sustainable returns. And third, by treating the market as your servant, you finally get control over that emotional, self-sabotaging behavior that took down even Sir Isaac Newton.
And this is really the final challenging question that Graham leaves us with. The market is always going to be a pendulum, swinging wildly between fear and greed. That's never going to change. The real question is, are you? Because the key to being an intelligent investor isn't about perfectly predicting the pendulum swing. It's about making sure that you don't become the pendulum yourself.